Thank you for joining us at xn.com for this Forex Preview video. We'll be looking at the trade talks resuming this week. I'm Christina Marujos, and joining me today is investment analyst Mario Sachikiriakos. So we're expecting American and Chinese negotiators to meet on Thursday and Friday in what markets hope to be a successful round of trade talks. Now, the stakes are very high heading into this one, as President Trump threatened he will hike his tariffs in 1 week unless something is agreed right now. So do you think we'll see China buying U.S. agricultural products in exchange for Trump postponing his tariffs?
That's a very close call. If I had to choose one of the two, I would choose no deal, but there are strong arguments on both sides, and let me lay them out. So, arguing for a deal, if we look at this from the US side, the economy is really starting to weaken. We've seen the manufacturing sector come to its knees as a result of the trade war. Now that weakness is starting to infect the much larger service sector. And overall, it's clear that the overall economy is hurting from the trade war. Now, if you're Trump, that doesn't really help you heading into an election year. You want the economy to be as strong as possible if you're going to be re-elected. So Trump has a real incentive to take a mini deal and get some short-term economic relief. Now, additionally, one of Trump's biggest voting constituencies are farmers, US farmers. So if he agrees China to start buying US agricultural products, that also helps him score some political points as well. So Trump probably wants some deal this week. China wants a deal as well. The Chinese economy is struggling as well. It's struggling despite some substantial stimulus measures by the authorities there. And actually, what's really interesting about that is that China as an economy is already very leveraged. So the more stimulus you do, it's like a double-edged sword. It helps growth, but it also amplifies financial stability risks. If a shock hits at some point in the future, it might be amplified due to how leveraged the economy is. So China has been stimulating, and that has been supporting growth a little bit, but you don't want to play that game for very long. So both sides have an incentive to strike a deal. However, I think that the incentives against the deal are even stronger. Now, from the US side, Trump's whole approach this entire time has been maximum pressure. Whenever China has not played ball, Trump's response has always been up the stakes, do more tariffs, escalate the situation, and so on. Now, if you give them a mini deal, that takes a lot of the pressure off. And that, in my opinion, diminishing pressure means that China has less incentive to do a real deal, anytime soon. So if you do give China a mini deal, that takes the pressure off of them to strike a big deal, which is what you want really. From China's perspective, it's something very similar. If you give Trump a mini deal, he gets something to present to the US electorate as a victory ahead of the elections, so you might even be helping his re-election chances. So it's a very close call. I think the arguments against the deal this week are stronger though.
Okay, let's have a look at the markets now. Assuming you are correct and we don't get a deal this week, how will that impact the markets, and which assets do you think will be affected the most?
Well, in the markets, assuming we get no deal, we would likely see stocks heading lower. The dollar would likely lose as well, as the probability for Fed rate cuts this year rises further. And the main winners would be safe haven assets, so the Japanese yen, gold in all probability. Now, in the opposite scenario, if we do get a deal, we're likely to see the opposite market reaction. Stocks and the dollar would likely soar, but safe haven assets like the yen and gold would likely head lower.
I see. Well, we'll be on the lookout at the end of the week for any updates on the trade talks. Marios, thank you for joining me today, and thank you for watching us at xn.com.